Hey everyone, and welcome back to the channel. Today, we're digging into the numbers from Adani Energy Solutions Limited, or AESL, formerly known as Adani Transmission Limited.
That's right. AESL is a major player in India's energy sector, primarily involved in power transmission and distribution. They also have interests in smart metering and cooling solutions. It's a pretty diverse energy company with a large portfolio of subsidiaries involved in specific transmission projects and distribution areas, like Adani Electricity Mumbai Limited.
Exactly. And they've just released their audited financial results for the fourth quarter and the full financial year ended March 31, 2025. These results were approved by their board of directors on April 24, 2025. We'll be looking at both the consolidated and standalone figures today.
Sounds good. Let's jump into the consolidated results first. How did they do on the top line?
Okay, for the consolidated entity in Q4 FY25, revenue from operations came in strong at 6,374.58 crore rupees. That's a solid jump compared to the 4,706.85 crore rupees in Q4 of the previous year.
Nice growth there. And for the full year?
For the full financial year 25, consolidated revenue was 23,767.09 crore rupees, up significantly from 16,607.36 crore rupees in FY24. So strong top-line growth both quarterly and annually on a consolidated basis.
What about profitability? Let's look at profit before tax or PBT.
Right. Now this gets interesting due to regulatory accounts and an exceptional item. If we look at profit before rate-regulated activities, exceptional items, and tax for the consolidated entity in Q4 FY25, it was 1,184.79 crore rupees, a huge increase from 496.35 crore rupees in Q4 FY24. For the full year FY25, this figure was 3,921.62 crore rupees, up from 2,239.57 crore rupees in FY24.
Okay, but you mentioned regulatory accounts. How do they factor in?
Good point. There's a line item called net movement in regulatory deferral account balances. This represents timing differences in recognizing certain incomes and expenses as per regulatory approvals. In Q4 FY25, this was a negative impact of 210.84 crore rupees, whereas it was a positive 55.60 crore rupees in Q4 FY24. For the full year FY25, the negative impact was larger at 1,340.75 crore rupees compared to a negative 460.01 crore rupees in FY24.
So that adjusts the profit before tax. And what about exceptional items?
Yes, for the full year FY25, there was a significant exceptional item charge of 1,506.02 crore rupees on the consolidated statement. There was no exceptional item in Q4 itself, nor in the previous financial year.
We'll definitely need to unpack that exceptional item later. So after considering the regulatory adjustments and the exceptional item, what's the final PBT?
For the full year FY25, the consolidated PBT stands at 1,074.85 crore rupees. This is actually down from 1,779.56 crore rupees in FY24, primarily due to that large exceptional item. For Q4 FY25, PBT was 973.95 crore rupees compared to 551.95 crore rupees in Q4 FY24, as the exceptional item didn't hit this specific quarter.
Okay, so PBT down for the year because of the exceptional hit but up for the quarter. What about profit after tax or PAT, the final bottom line, including any final regulatory adjustments?
Consolidated for Q4 FY25 was 713.66 crore rupees, up nicely from 381.29 crore rupees year over year. However, for the full year FY25, PAT was 921.69 crore rupees, a decrease from 1,195.61 crore rupees in FY24, again reflecting that exceptional charge.
And how does that translate to earnings per share or EPS for the consolidated entity?
The consolidated basic EPS for Q4 FY25 was 5.50 rupees compared to 3.24 rupees in Q4 FY24. For the full year, it was 9.05 rupees, down from 10.20 rupees in FY24.
Got it. Now let's quickly look at the standalone results. How do they compare?
On a standalone basis, revenue from operations for Q4 FY25 was 1007 crore rupees, more than double the 415.67 crore rupees in Q4 FY24. For the full year FY25, standalone revenue was 1937.75 crore rupees, up from 1517.35 crore rupees.
Significant growth there too. And standalone profitability?
Standalone PBT for Q4 FY25 was 206.53 crore rupees, up substantially from 74.34 crore rupees year over year. For the full year FY25, PBT was 626.60 crore rupees, slightly down from 659.34 crore rupees in FY24.
And the standalone PAT?
Standalone PAT for Q4 FY25 was 197.68 crore rupees, compared to 74.34 crore rupees in Q4 FY24. For the full year FY25, PAT was 617.75 crore rupees, compared to 594.91 crore rupees in FY24. So standalone PAT is up for the year, unlike the consolidated PAT which was hit by the exceptional item.
Interesting divergence. And the standalone EPS?
Standalone basic EPS for Q4 FY25 was 1.65 rupees versus 0.66 rupees. For the full year FY25, it was 5.27 rupees, slightly down from 5.33 rupees in FY24.
What about other income? Was it significant for either consolidated or standalone?
Yes, other income was quite substantial for both. Consolidated other income for FY25 was 679.46 crore rupees. Standalone other income was even more significant relative to its revenue at 1108.56 crore rupees for FY25. This often includes things like interest income, dividends from subsidiaries for the standalone entity, etc.
Okay, let's talk profitability margins. Given the exceptional item and regulatory adjustments, how did the consolidated margins look?
The consolidated net profit margin for FY25, calculated as PAT divided by total income, comes out quite low at around 3.77%, heavily impacted by that exceptional loss. If we looked at it before the exceptional item and regulatory movements, the picture would be much stronger, but the reported bottom line reflects these hits. The Q4 margin was better at about 10.82%.
And the standalone net profit margin?
Standalone net profit margin for FY25 was around 20.28%. That's much healthier, highlighting that the core standalone operations and income streams including potentially dividends from subs are quite profitable, and it wasn't directly impacted by the large exceptional item booked at the consolidated level.
Now let's circle back to that exceptional item on the consolidated accounts, 1506.02 crore rupees for the year. What was that about?
According to Note 5 in the results, this relates to Adani Electricity Mumbai Limited, or AEML, a subsidiary. AEML divested its Dahanu Thermal Power Plant as part of its ESG commitment. The transaction price was 815 crore rupees, but the carrying value of the plant in the books was 2,321.02 crore rupees. This difference resulted in the loss of 1,506.02 crore rupees, which was booked as an exceptional item.
Wow, that's a significant divestment loss. Definitely explains the drop in consolidated PAT for the year. Okay, let's shift to the balance sheet. What are the key takeaways regarding debt and equity, comparing consolidated and standalone as of March 31, 2025?
On the consolidated side, total equity stands at 23,011.26 crore rupees. Total debt, which is non-current plus current borrowings, is substantial at around 40,206.08 crore rupees.
And standalone?
For the standalone entity, total equity is 19,698.77 crore rupees. Total standalone debt is much lower at about 7,900.17 crore rupees. This difference makes sense as the consolidated debt includes borrowings across all subsidiaries, many of which are capital-intensive transmission projects.
Did the regulatory deferral accounts show up on the balance sheet too?
Yes, on the consolidated balance sheet, there's a regulatory deferral account asset of 3,087.61 crore rupees and a liability of 93.72 crore rupees as of March 2025.
Okay, how about cash flows? The consolidated report usually includes a statement. Any highlights from there for FY25?
Yes, The consolidated cash flow statement shows a strong net cash generated from operating activities of 8,695.22 crore rupees for FY25, up significantly from FY24.
That's positive. What about investing and financing activities?
Investing activities saw a huge net cash outflow of 15,227.59 crore rupees. This was driven by large purchases of property, plant and equipment, acquisitions of subsidiaries, purchases of investments, and acquisition of regulatory assets. Financing activities saw a large net inflow of 7,975.22 crore rupees, primarily from the issuance of shares and long-term borrowings, offset partially by repayments and finance costs paid.
So heavy investment funded partly by operations and significantly by financing. Did they mention any dividends paid?
The financing cash flow doesn't show a dividend payout line item for FY25, though there was one in the previous year shown for comparison. And as expected, there's no standalone cash flow statement presented in these results documents.
Alright, let's get into the segment performance based on the consolidated results. How did the different business segments, transmission, distribution, trading and others, perform in FY25?
Transmission remains the star in terms of profitability. For FY25, its segment revenue was 8,330.59 crore rupees and it delivered a substantial profit before interest and tax, or PBIT, of 3,428.66 crore rupees. It also holds the largest chunk of segment assets at over 39,000 crore rupees.
Okay, what about distribution? That includes the Mumbai business, right?
Correct. Distribution actually had the highest segment revenue at 12,266.48 crore rupees. However, its PBIT was remarkably low at just 19.10 crore rupees for the full year. This segment also has significant assets over 20,000 crore rupees.
Wow, huge revenue in distribution but very little profit contribution. That's something to note. And trading and others?
The trading segment had revenue of 1,380.44 crore rupees and a PBIT of 14.22 crore rupees. The other segment, which likely includes smart metering and other initiatives, had revenue of 1,789.58 crore rupees and a PBIT of 192.57 crore rupees.
So transmission is the profit engine, distribution drives revenue but struggles with profitability, and trading and others contribute modestly. Interesting mix.
Definitely, the low profitability in the large distribution segment seems like a key area to watch.
Okay, summarizing the year-over-year performance. Consolidated revenue is up but PAT is down due to the Dahanu plant divestment loss. Standalone revenue is up and PAT is also slightly up. What does this suggest overall?
It suggests the underlying transmission and other businesses are growing and performing reasonably well. The consolidated bottom line was pulled down by a specific, large exceptional event. The regulatory account movements also add complexity to interpreting the reported profit trends year on year. The standalone performance looks quite robust, buoyed possibly by income from its numerous subsidiaries.
Now the note section often contains crucial information. You mentioned the exceptional item, but there were other significant notes regarding investigations and legal matters, right?
Yes, notes 3 and 4 are quite important. Note 3 discusses the aftermath of the short seller report from 2023. It mentions the Supreme Court order, ongoing SEBI investigations too were pending, now believed concluded, and SEBI show cause notices, one regarding a former auditor's peer review certificate and another alleging wrongful shareholding categorization from FY2012 to 2020. The management states they believe there are no material consequences from the SSR and that the company complies with laws.
And Note 4?
Note 4 mentions that in November 2024, the company became aware of a U.S. Department of Justice indictment and a U.S. SEC civil complaint against a non-executive director for alleged securities fraud related to misleading statements and omissions. AEE's itself is not named in these matters, and the company states there's no impact on these financial results.
Okay, so the company is acknowledging these external events but asserting no material impact on the current financials. Investors should definitely be aware of these points. We also discuss Note 5 on the Dahanu divestment and Note 2 explaining the regulatory deferral accounts impact.
Correct. These notes provide critical context beyond the headline numbers.
Absolutely crucial. Now let's turn to the auditor's report. Walker Chandiok and Company LLP audited both the consolidated and standalone results. What was their opinion? Any qualifications or red flags?
This is key. For both the consolidated and standalone financial results, the auditors issued an unmodified opinion. This means they believe the financial statements give a true and fair view and comply with the accounting standards. There are no qualifications or adverse opinions, which is a positive sign.
That's good news, especially given the complexities. Did they mention any emphasis of matter or other matters?
Yes, under other matters in the consolidated report, they noted their opinion isn't modified regarding their reliance on the audit reports of other auditors for 64 subsidiaries. These subsidiaries represent significant assets around 39,894 crore rupees and revenues around 9,110 crore rupees. They also noted that 2 subsidiaries were unaudited, but their financial statements were certified by management and are considered immaterial nil assets and revenue.
So, standard practice for a large group relying on component auditors. Anything else?
Both reports, consolidated and standalone, also include an other matter paragraph stating that the figures for the quarter ended March 31, 2025, are balancing figures derived from the full year audited figures, and the published year-to-date figures for the 9 months ended December 31, 2024. Again, this is standard practice for quarterly reporting alongside annual results. Overall, the auditor's reports are clean.
Excellent. So, putting it all together, what's the outlook and what are the potential risks for Adani Energy Solutions? And please include the standard disclaimer.
Disclaimer: we are just discussing the results, and this is not investment advice. Please consult with a certified financial advisor before making any investment decisions. Based on these results, the outlook seems mixed, but leaning positive on operations. The transmission segment continues to be a strong profit generator. Revenue growth across segments is robust. The company is clearly investing heavily in expansion, as seen in the cash flow. However, the low profitability of the large distribution segment is a concern. The exceptional loss from the Dahanu divestment hit the annual profit significantly, though it's positioned as a strategic ESG move.
And the risks?
Key risks include improving the profitability of the distribution business, managing the large debt load effectively, execution risks associated with their significant capital expenditure program, and the complex regulatory environment they operate in. Additionally, while the company states no material impact, the overhang from the SEBI SCNs and the US legal matter concerning a director could pose reputational risks or potential future distractions.
Alright, let's wrap this up. What are the main takeaways?
Okay, Adani Energy Solutions showed strong consolidated revenue growth for Q4 and FY25. Consolidated PAT was up for the quarter but down for the full year due to a major exceptional loss from the Dahanu plant divestment. Standalone results showed strong revenue growth and a slight increase in annual PAT.
Transmission remains the profitability backbone, while the high revenue distribution segment struggles with profit margins. The company invested heavily, funding it through operations and significant financing, including share issuance. Importantly, the auditors gave an unmodified clean opinion on both consolidated and standalone results, though they noted reliance on other auditors for many subsidiaries in the consolidated report. The notes on SEBI matters and the US indictment add important context for investors to consider.
A complex picture, but the underlying operational growth seems evident, albeit overshadowed by the exceptional item in the annual consolidated numbers.
If you found this analysis helpful, remember to like, share, and subscribe for more financial breakdowns. See you next time.
That's all the time we have for today. Thanks for tuning in.